Hi everyone, welcome to Tuesday's training. My name is Kendra Ferguson. I'm a CPA, CFO, and job costing expert focused specifically on helping construction companies boost their profits, maximize their cash flow, and ultimately make their lives a lot easier. If you're joining me live tonight, I would love for you to let me know you're here. So drop a comment, tell me where you're coming in from. I am personally in Asheville, North Carolina. I thought it would also be fun, maybe on these weekly trainings, if I'm doing them in the evening, to also enjoy a little beverage just to kind of celebrate making it through. Monday, particularly, was rough for me this week. So I'm from Asheville. It's kind of known as like one of the craft brewery capitals of the United States. So I really love local craft beer. Tonight I'm drinking something from Blowing Rock Brewing, which is also in Western North Carolina. So have a beverage with me as well and let me know what you're drinking. I'm going to take me just a second to work out my tech, make sure that I am going live in the Facebook group. Go ahead and let me know where you're coming from if you haven't already. Perfect. It does look like I'm live. I'm going to try to monitor the chat. So if you have questions as we're going through tonight's training, just feel free to drop the question. I'll try to keep an eye on it so that I can answer those before we get off this evening. So as I mentioned in the headline and the event for this, we're going to be talking all about why your gross margin may not actually be as high as you think it is or lower than you think, to make it a little bit more simple. This is a really common thing I see with contractors that end up coming to me and working with me. They often have a feel for what their gross margin is. And often when we get into the details of their books and dig into things, it's often a little bit lower than what they were expecting. And one kind of extreme instance, I worked with a roofing company over the last few months. And on the very first call that we had, they told me, I think our gross margin is probably between 30 and 35%. And I got access to their QuickBooks file and was looking through their profit and loss statement. And I said immediately, this is not making sense to me. And so I'm going to talk about some of the reasons why they felt that their gross margin was so high and why in actuality it was only 18%. And that was quite a big difference and was something that led to them having major profitability issues, which is ultimately why they came to me. So if you have questions as we're going through it, remember to drop them in the chat. So I wanted to start off just by going over what is gross margin. So we should all be on a level playing field in terms of defining what that is. And so I wanted to, it's sometimes with these numbers and these ratios and statistics, it's easier to just show you. So I wanted to share really quickly a spreadsheet I put together. Let me pull it over here really quick. So ultimately, your gross margin is the difference between your revenue or sales, whichever term you like. I personally prefer revenue, less your cost of goods sold or your cost of revenue. And oftentimes what people assume that their cost of goods sold is are just the direct related job costs associated with performing a job. And they often forget that your cost of goods sold should actually also include any indirect job related costs. So common indirect costs that are frequently seen in construction companies are you'll have some payroll related overhead. So maybe you're paying health insurance premiums, workers' comp, etc. That's all overhead that should be attributed to jobs, although it's often sometimes difficult to allocate. As well as equipment. I work with a lot of contractors who have a lot of heavy equipment that they're using to perform their construction, and your jobs use that equipment. And so that the use of that equipment should be allocated to those individual jobs. And that often is a little bit more complicated to figure out how to allocate all of that overhead or indirect costs. And overhead and indirect costs are kind of interchangeable. But your gross margin is calculated with those indirect costs or overhead included. So gross margin is your revenue less your cost of goods sold. So I'll just point it out here. Revenue minus your cost of goods sold, which is made up of two components, your direct costs and your allocated indirect cost. So your gross profit or margin is the difference in this scenario on this job of $200,000, which was their contract price or their sales for that job, less $130,000 in direct costs, less $33,000 in indirect costs, for total costs to perform that job of $163,000. So in this instance, their gross profit was $37,000. And let's just calculate what percentage that is really quick. As a percentage of sales, that is 18.5% on that particular job. And I wanted to show this setup in particular tonight because I'm still running into a lot of construction companies and contractors who are not tracking their job costs down by the individual job within their accounting software, and they're just tracking their total costs in their profit and loss statement in their accounting software. And I wanted to give you this example tonight because I'm always talking about job costing and I'm such a proponent of it. It really will increase your profitability when you do it properly. And so I'll never miss a chance to be such a proponent of job costing. But if you're looking at your total column, which is in this spreadsheet, it's just the sum of 5 jobs. I'm saying you're a pretty basic construction company. You've only got 5 jobs going on maybe in a year, and your revenue is a little over 1.1 million. It's taking you $810,000 to actually perform those jobs for directly identifiable costs. And that would be subcontractors, directly identifiable labor, materials, etc., as well as your indirect cost of $160,000. So in this particular instance, total gross profit for this made-up company is about $150,000, which that's in dollars, but I really like to talk in percentages when we're talking about gross margin. And so in this instance, 13% is the actual gross margin for this fake made-up company, which in what I see really frequently is contractors are just talking about those direct job-related costs. And in this instance, that would actually, you would be missing out on 14% of your sales in terms of indirect costs if you're not figuring that into your gross margin calculation. So with both your direct and indirect, this fake company has a 13% gross margin. And then in addition, they also have some expenses to just keep the business running. Maybe you've got an office lease. Maybe you have a truly administrative staff person. And so you've got some other selling, general, and administrative costs. I just made up a number here of 7%. So at the end of the day, this made-up company is netting 6% of their sales in terms of a net profit or margin, which, depending on the type of construction you're in, maybe that's actually really good. Margin, net profit percentage varies widely depending on the type of construction you're doing. If you're interested in kind of knowing what's typical in your particular area of construction, maybe you're doing residential, maybe you're a roofer, etc. I have some information that I could share with you about kind of what's most common in your particular area of construction. But I wanted to just, again, point out that you're likely, I'm not saying everyone is doing this, but you're likely probably forgetting about your indirect cost allocation. And this is particularly concerning to me for contractors who may be doing cost plus contracts. I talked to a construction company earlier, actually just yesterday, who in the wake of COVID, after getting really hit hard on some jobs where they didn't necessarily have either an escalation clause or any kind of way to account for the severe and significant material price increases we saw as a result of COVID, they really lost a lot of money. They have now decided to go to strictly a cost plus contract format. And we were talking as well, and they weren't currently allocating or charging anything for kind of project management or superintendent time in that amount that gets charged to those jobs, of which the whatever percentage you determine with your contract goes on top to give you your total contract price. But they weren't allocating that to any of their individual jobs. So essentially, that was, if they had it structured where it was cost plus 15%, all of their project management related payroll, which for this company, they were relatively small. It was a 3-person kind of company, and so they were all kind of doing project management related things, but they weren't charging that. And so that was immediately eating into the 15% that they were charging on top of their actual contract costs when those costs can be allocated. You can determine based on either the number of hours that is actually spent on it, or come up with a reasonable allocation method. That's something you could easily charge and get 15% then on top of that, instead of having to have half of your 15% profit in this particular scenario get eaten up with additional payroll costs. So that's a particular concern to me. I know people are trying to do kind of some trying to just come up with anything that they can possibly do to protect themselves more in the wake of COVID. But I want to make sure that when we're doing things like that, we're thinking all the way through and thinking about all the different kinds of scenarios. Kathy said she was literally just having this conversations with one of the contractors she works with. Common. I mean, I'm having conversations like this all the time, unfortunately. But fortunately, that the conversations are starting to happen, so progress can be made when you're talking about it. So that's really good. I wanted to kind of switch over from talking about what exactly is gross margin and what does that look like to something I also get pretty frequently, and show you a little bit about maybe the difference in markup and margin. That's something I see frequently misunderstood within the industry. And so I wanted to just show you really quick, a really basic example just to kind of drive home a point. Because I see and I talk to contractors and construction companies frequently who are kind of thinking that the two are interchangeable, and they are not. Particularly as you become a larger company, the differences between markup and margin may get smaller and smaller, but there's still a true difference. So let me walk through that with you really quick. So in this particular scenario, I'm saying you're doing a really basic job. Maybe you just have materials of $50,000 and labor of $30,000, and that's literally it to accomplish this job. For this basic scenario, just to point something out, I'm not talking about indirect costs in this scenario. And you're going to mark both of those up 15% to come to your contract price. So your markup in this situation is 50%, which equates to a total contract value of $120,000 off of $80,000 total cost. Now, when we go back to our previous kind of scenario where we're looking at kind of profit and loss for this job, the revenue for this job is going to be that $120,000, the marked up amounts, as well as, and you're going to subtract the cost that's going to take you to do this job, which is $80,000 in this instance, and come up with a gross profit of only $40,000. And when you calculate that $40,000 as a percentage of your sales price or your revenue on this job, that's actually only 33%. So I run into this quite a bit with contractors where they're like, oh yeah, I'm marking everything up 50%. Like, I'm making a ton of money on this job. When in reality, not to say 33% is not a bad gross margin, because it's typically pretty good depending on the structure of your company. But it's still less than 50%. And I just want to make sure that everyone understands that there's a difference between markup and margin. And if you have any further questions about that, then I'd love to talk more, maybe point out some specific scenarios to you about your own particular business to further drive home the fact that markup is definitely a different thing from margin. So going back really quickly to our previous scenario, I want to talk about some other instances where I've seen contractors kind of run into the issue where their perception of gross margin was greater in reality when I looked at their profit and loss statement. So oftentimes what I see is contractors will have their profit and loss or their chart of accounts on their profit and loss statement not quite set up in this format. And so you might actually have a lot of your payroll expenses down here in your selling, general, and administrative expenses section of your profit and loss statement in your accounting software. Maybe you're using QuickBooks. That's the one I see most commonly. And so you just might not have the picture of your true gross margin when your payroll is really down in this section. At the end of the day, the math will all come out down the same when you're looking at net profit or margin. But if you're pricing your contracts based on the expected gross margin that you're going to get, and let's say you're expecting to get 25%, but you're not including all of those payroll expenses or all of those equipment expenses or a lot of those indirect related items, then you're shooting yourself in the foot when you're going to estimate and price your jobs, especially if in this environment when there's so much work out there, and competition is lower than normal. It's just I don't want you to be in the scenario where you're missing out on things just because your chart of accounts is essentially not set up to properly calculate your gross margin. So that's another example. Another example I ran into, and let's talk about the roofing company again, is one of the big things that they were missing in calculating their gross margin was payroll tax. So that's kind of another payroll related thing. So they were accounting for their payroll tax down here again in their selling, general, and administrative sections of their profit and loss statement, and not allocating that to the individual job to come up with the true gross margin percentage. And payroll tax is an easy way. It's very easy to allocate that to the job, particularly if you're already allocating direct labor based on the number of hours people are working. Payroll tax is very easy to allocate as well. It's just percentages. But they weren't doing that. And so that in that particular instance, that's 7.65% of their payroll costs. And that for them, they're a $5 million company, that really added up for them. And so they weren't thinking about that. And so when they were analyzing their pricing structure, that was just not even a consideration for them. Another instance with this roofing company is they weren't allocating their credit card charges to jobs in their accounting system to individual jobs. So they were missing out on a lot of small trips to Home Depot to get extra wood, or small tools, etc. Fuel was a big one for them as well. And so they weren't allocating those to the individual jobs, and they were just kind of lumping them down here in this kind of general and administrative expenses section of their profit and loss statement. And that just further ate into what they thought that they were getting in gross margin, because in actuality, it was quite a bit different from what they thought. So that's another common thing. And I see this also very frequently when contractors are not job costing within their accounting system. So if you're still kind of doing things where maybe you're collecting your receipts and your invoices in a physical file folder, a file cabinet, and you're using that to kind of keep track of your costs. I still see that quite frequently, unfortunately. You are almost guaranteed, 95% guaranteed, I would say, to miss costs in that scenario. And that was actually another thing that this roofing company was experiencing. They were, at the end of the job, they had a job costing spreadsheet with some primary categories where they were capturing the big things like the materials to do the roofs, the labor to do the roofs, commissions to their salespeople to do the roofs. And unfortunately, they weren't capturing all of those extra credit card charges for the extra supplies. They were often missing costs for permits, etc. And that's just really common when you're doing that kind of manual job costing. We want to get you to the scenario where you are easily job costing everything in your accounting system. It is not too terribly difficult to get set up. It saves a ton of time. Your office people will love you. Your administrative people will love you. If we can get to that point where they're not having to constantly file papers to come to, especially if there's a question about a particular expense when you're analyzing the job later. It's a lot easier when it's kind of all in your accounting software or all electronic. It's so easy to find. So that's something I help a lot of contractors with, and I really enjoy that side of things. Let me check the comments again, because I know that I've been, Kathy, workers' comp and liability insurance, yes. Definitely something that people quite often don't think about in terms of trying to allocate that. And you can allocate that to a job. You just need a proper method set up in order to be able to do that. So those are kind of some of the big things that I see when people are typically missing costs within their gross margin calculation. But it's a really important thing to try to get right, because you want to make sure that you're pricing your jobs appropriately to achieve your desired gross margin. And not only your desired gross margin, but then also being fully aware of the other costs that you're incurring in your business kind of below that gross profit line, to make sure that your ultimate net profit percentage is a reasonable one, and is one that's going to help you build the business that you enjoy working in every day, and will ultimately help you build kind of the business that you're looking to build longer term for your family. Either if you're planning to continue to grow your business or sell your business eventually, it's important to make sure that and it's possible. There's so much opportunity in the construction space right now but having the systems in place to be able to track these things as quickly as possible and keep it up to date, it's just so important these days. So if you're struggling with any thoughts about gross margin, or kind of just how you can set your systems up in order to be able to capture these things on a more real-time basis, then definitely send me a message, reach out to me, leave me a comment. I'll be happy to chat about it. That's probably my favorite thing to do, is to help contractors figure out how to make job costing work for them in a way that's not going to be totally burdensome, but is going to give them so much more information about how to better run their jobs, better estimate their jobs going forward into the future, and just ultimately boost their profits, because that's kind of what it takes. So I'm going to go ahead and hop off. Thank you so much for joining. Let me just check real quick to make sure no one else has left a comment. Nope, it looks like we're good. So thank you everyone for joining. If you're hopping on the replay and you have any questions throughout, then you just leave me a message. I'll be happy to answer and talk about anything. Other than that, I'll be back next week for another training. I haven't quite decided what I wanted my topic to be, but if you have thoughts, feel free to send me a message. I'm happy to talk about anything that's of relevance to anyone in the group. So good luck to everyone. I hope you have a fantastic week. I'm going to go enjoy the rest of my beer, and I'll talk to you all in the group, and catch me next week for another live training. Thanks.